Hey everyone. So in last class, we talked about there are 9-step accounting cycle. And in today's class and the next two classes, we're going to continue to talk about each of the steps in the 9-step accounting cycle. So to begin with, let's do a brief review. Please take a minute, think about what are the 9-step accounting cycle. So here are the 9-step accounting cycle. We begin with analyze business transaction. What is a business transaction? Starbucks bought some coffee bean. That is a business transaction. And then for accountant, once a business transaction happen, they need to analyze the effect of the business transaction on the accounting equation. Specifically, how does the business transaction, how does this event affect asset, the firm's asset, liability, and stockholders' equity? And then the second step is generalizing. We're going to talk about it more in today's class. But generalize, basically, it means make a journal entry, debit some account for some amount, credit some other account for the same amount. So this is the most simple journal entry. And then afterwards, we do the posting. We try to post the information in each journal entry to specific account. So for example, if the journal entry is to debit cash, 100, credit revenue, 100. In the posting stage, we post it to the cash account because it's a debit of 100. So we write it, the left-hand side is debit, the right-hand side is credit. So we write it on the left-hand side. We debit cash account by 100. And also the journal entry affects the revenue account as well. So we post it to revenue account. And because we credit revenue for 100, so here when we do the posting, we post it to the right-hand side, the credit side of the revenue account for 100. So this is posting. We're also going to talk more about it in today's class. Trial balance, basically at the end of the financial reporting period, we're going to take the balances for each account and make it into a list, which is called trial balance. Adjusting entry. So some of the journal entries that we need to make during the period, it's not initiated by a source document. So during the normal process of making those journal entries, we didn't get to make it. So at the end of the financial reporting period, we need to look at what journal entry we need to make, which hasn't been made yet. And then we need to, those are called adjusting entries. We need to make those journal entries. And then after we have made those journal entries, we need to do posting and then adjusted trial balance. So the financial statement that firms investors outside information users see, those financial statements, those are generated based on the firm's adjusted trial balance. And afterwards, we need to close out some of the temporary accounts and then have a post-closing trial balance. So in last class, we talked about the first step. And in today's class, in this class, we're going to talk about step 2 to step 4. And then we're going to continue to talk about the 9th step in the next 2 classes. So what do we mean by analyzing business transaction? It's basically to analyze the effect of an event on each of the components of the accounting equation. An example is, for example, AB received 1,200 cash from customer for app development service it has performed. And then we analyzed it because the firm has received cash. So the firm has more cash increase. And because cash is an asset account, so asset increase. And then because this is for the firm has performed some service, so revenue increase. The firm is able to generate revenue, and revenue is part of retained earning. Retained earning is part of stockholders' equity, so stockholders' equity increase. And one thing to remember is every transaction is going to have a dual effect. It's either going to increase asset, increase liability, and stockholders' equity, all stockholders' equity or increase asset and decrease asset. So it's always going to have a dual effect. Yeah, so this class we're going to cover generalizing, posting, and try banners. Before we talk about journal entries and generalizing, I want to talk about some basic terms, accounting terminologies. The first is account. So what is an account? So we actually have already mentioned it. So in the example I gave in the review, like 2 minutes ago, I talked about a journal entry, which is debit cash, 100, credit revenue, 100. So in this example, cash is an account, revenue is another account, and debit cash 100, credit revenue 100, that is an example of a journal entry. So what is an account? The formal definition is, it is an individual accounting record of increase and decrease in a specific asset, liability, or stockholders' equity item. So cash is an asset item. Revenue is part of, it is going to close out into retained earning, and eventually it's part of stockholders' equity. So account basically, it records the increase and decrease in those items. So for example, the cash account is going to increase, it's going to record the increase and decrease in cash. Revenue is going to record increase and decrease in revenue. And then later, you are going to hear another term called general ledger. What does that mean? That just means that it is a collection of all of the firm's accounts. That is called a general ledger. And an account usually composed of 3 parts. The title of the account. So for example, cash, revenue, those are the title of the account. It also has a debit side, has a credit side. Debit side is also the left-hand side. Credit side is the right-hand side. So those are the 3 components of an account. And then we use, depending on, actually we're going to talk more about it later, but depending on what kind of, whether an account is an asset account, liability account, or stockholders equity account, debit and credit has some relationship with increase and decrease in the account. This we're going to talk more about it in maybe 2 minutes. And in the classroom, we're going to, in order to demonstrate an account, we're going to use something like this. So we're going to write it as, for example, cash. We're going to write it as a T in order to separate the debit side and credit side, the left and right side. So, and this is called a T account. So T account is something that we only use for illustration purpose. In real life, you're not, when you go to the firm and you look at their accounting record keeping system, you're not going to see a T account there. What you are going to see is something like this. So the firm is going to have the name of the account and some form of system that is keeping track of the debit. So what is the amount that is debited and what is the amount that is credited to this account? And as we mentioned before that, the debit and credit, depending on what kind of account it is, it has a relationship with increase and decrease in the account. So for example, here, because cash is an asset account, and for all of the asset account, the debit side means increase, the credit side means decrease. So here, if we debit cash 4,000, it means that the cash account increased by 4,000. And if we credit cash 500, it means the cash account is decreased by 500. So this is account debit, and this is what an account looks like. And we just talked about debit and credit. So as we mentioned previously, debit, what does debit and credit mean? Debit simply means left, credit means right. So no matter whether it's an asset account, liability account, or stockholders' equity account, debit always means the left-hand side, credit always means the right-hand side. And so we use debit and credit to describe where entries are made in accounts. They do not mean increase or decrease. The relationship between debit and credit and increase and decrease, it depends on what kind of account it is. So for example, if it's an asset account, debit means it's going to mean increase. Credit is going to be, credit means decrease. However, if it's a liability or stockholders' equity account, it will be the opposite. For a liability account, the credit means increase and the debit means decrease. So this is how we keep the accounting equation always equal. If for liability accounts, it's the same association of increase and decrease with the increase and decrease has the same association between debit and credit just as asset. The accounting equation is not going to be equal. So those has to be the opposite. And for stockholders' equity account, it's the same thing. If it's common stock, credit means increase, debit means decrease. Retained earning, credit increase, debit decrease. And for revenue, expense, and dividend, revenue is the same as retained earning, but for dividend and expense, those are the opposite as retained earning. So this relationship is very, very important. So we just mentioned last class, if there's one thing I want you to take away from this class, that is the basic accounting equation. Asset equals to liability plus stockholders' equity. And if there's a second thing I want you to take away from this class, this is this association. So for different accounts, debit and credit have different association with increase and decrease. So after we have recorded all of the journal entries, the account is going to have a balance. We just talked about the journal entries we made. Those are going to affect each individual account. And during the period where the firm is going to have a lot of journal entries, because each transaction, if it affects the accounting equation, it needs to be recorded. And then every time the firm make a journal entry, it's going to affect some account. So and then after the firm has recorded all of the journal entry, actually the firm needs to do the posting, and after those journal entries are posted to the account is going to have a balance, to have an ending balance. And normally, the balance of our account is going to be on the side where the increase of the account is recorded. So for example, if it is an asset account, normally the balance is going to be on the debit side. If it's liability or stockholders' equity account, normally the balance is going to be on the credit side. And specifically, for common stock and retained earning, the balance and also revenue, the balance is going to be on the credit side. However, for expense and dividends, the balance is going to be on the debit side. So this is about the accounts, debit and credit and normal balance. So another thing I want to mention before we go into talk about generalizing, posting, and trial balance is a double entry system. So the basic accounting system we're using now, accounting actually was invented about 500 years ago, and the current accounting system we're using now is called a double entry system. Which is the same as 500 years ago. It didn't change. So even though the way people keep records, They used to write it on paper, but now it's almost all automatic. However, the basic principle is still the same as 500 years ago, which is double entry. And what do we mean by double entry? Double entry, basically, it is record debit at least one account and credit at least one other account. This is called double entry. So we double entry. Every time we make a journal entry, we never just make journal entry on one account. We need to make it at least on two accounts, at least one debit and at least one credit. So, and here is an example of double entry system. AB received 1,200 cash from customer. So this example we just gave when we did the review. And the journal entry for this is we debit cash 1,200, credit revenue 1,200. So AB received cash 1,200, cash increase. And because cash is an asset account, so and then for asset, the increase in asset is recorded as debit. So that's why we debit cash 1,200. And then the firm performs service, app development service. So revenue increase by 1,200 as well. And because revenue account, it has the same sign, it's going to increase retained earning and stockholders' equity. And that increase in stockholders' equity is recorded as credit. So that's why we credit revenue 1,200. And we use this to indicate that cash account increased by 1,200. The firm has 1,200 more cash. And by recording credit revenue 1,200, we're indicating that the revenue account increased by 1,200 as well. So we have 1,200 more revenue. And then this is called, so this debit cash 1,200 and credit revenue 1,200. This is called a journal entry. And the process of making this journal entry, it is called journalizing. So in real life, a journal entry looks something like this. This is a very simplified way to write a journal entry. We use this in the classroom. However, if you go to the real life, you are going to see something like this. So firm is going to record the date of the journal entry, which accounts are affected. Account reference code. So bank account, the reference code for this account is J001. And the reference code for bank loans is J290. So the reference code for those accounts and the amount that is debited or credited. And here's the explanation of what this journal entry is. So here's an example. On September 1st, stockholders invested 15,000 cash in the corporation in exchange for shares of stock, and AB purchased computer equipment for 7,000 in cash. Please write down the journal entry for those. There's actually two transactions. Please write down the journal entry for these two transactions. You can pause your video for now. So the journal entry for the first transaction, we have the dates and then the account. Shareholders invested 15,000 cash. So cash increase, and because cash is an asset, for an asset, an increase in asset is recorded as debit. So we debit cash 15,000. And common stock, at the same time, common stock increase. Common stock is a stockholders' equity account. And the increase in stockholders' equity account is recorded as credit. So we credit common stock 15,000. And this journal entry basically means that the firm's cash increased by 15,000 and common stock increased by 15,000. And then AB Inc. purchased computer equipment for 7,000 in cash. So this transaction, because AB Inc. spent cash and purchase this computer equipment. The firm has computer equipment increase and cash decrease. And because both accounts are asset account, so the decrease in cash is recorded as credit cash, and the increase in equipment is recorded as a debit of equipment. Here's another example. On July 1st, AB company purchases a delivery truck costing $14,000. It pays $8,000 cash now and agreed to pay the remaining $6,000 on account. Please take 1 minute and think about how to write this journal entry. So AP Inc. purchased a delivery truck costing $14,000. By purchasing this truck, AP Inc. has a new asset, which is a truck. So equipment, the increase in truck, which is an asset, is recorded at the debit side. So we debit equipment 14,000. And then the firm pay out cash 8,000. So cash account decreased by 8,000. We credit cash for 8,000. And agree to pay the remaining 6,000 on account. So now the firm has a liability. The firm, by putting it on account, the firm had it made a promise to pay the 6,000 in the future. So now the firm has an obligation to pay it in the future. So this is agreed to pay the remaining 6,000 on account. This basically means that the firm's liability increased by 6,000. And specifically, this is called account payable. And because account payable is a liability increase, the increase in liability is recorded on the credit side. So account payable is going to be increased by 6,000. We need to credit account payable for 6,000. So that is, this is journal entry. And then the next step, after the firm has made those journal entries, the next step is to do the posting. And what is posting? Posting basically means that we transfer journal entry to ledger accounts to each individual account. So here's an example. The journal entry is to debit cash, credit common stock for 15,000. And then in the posting stage, this journal entry touch upon two accounts, cash account and common stock account. So in the posting stage, we need to post the information in this journal entry to each individual account that this journal entry affects. In this specific example, it affects cash account. So we need to post it to the firm's cash account. The first step in posting, on the cash account, we need to write down the date of this journal entry. And this journal entry is numbered J1. So the reference is J1. This is J1 journal entry. And the effect of this journal entry is it has a debit of cash 15,000. And at the same time, cash account, the reference number is number 101. So number 101 here. And then at the same time, this journal entry also touch upon the common stock account. And then we need to post it to the common stock account of a credit side of 15,000. And after we have done each posting, we need to update the balance in each account. So this is posting. Here we're going to go over some examples. So on October 1st, this person invested 10,000 cash in an advertising company. So this is what we covered in last class. We need to first analyze this transaction. This transaction, if we analyze it, this person invested 10,000 cash. So from the firm's perspective, cash is going to increase by 10,000. However, this represents stockholders' equity. the firm now has a new stockholder. And then, so stockholders' equity increased by 10,000 as well. And then cash is an asset account. Common stock is a stockholders' equity account. And then because cash is an asset, and the increase in asset should be recorded as debit. Common stock is a stockholders' equity, and increasing stockholders' equity is recorded as credit. So we can now write down the journal entry, which is to debit cash for 10,000, credit common stock for 10,000. And then after we have written down the journal entry, we do the posting. We post it to cash account, specifically because it's a debit to cash. So we post it to the left-hand side of the cash account or the debit side of the cash account. And then common stock is a credit, so we post it to the credit side of the common stock account. So this is the first example. The second example, so the firm purchased office equipment costing 5,000 by signing a 5,000 note payable. And then if you get more familiar with this, we can kind of skip like the basic analysis accounting equation. So firm purchase office equipment, which means office equipment increase. And office equipment is an asset, so we need to debit equipment for 5,000. And then in order to get this office equipment, the firm is accruing a liability. It now has an obligation to pay this 5,000 note payable when it's due in 3 months. So note payable is a liability, and the increase in liability is recorded at the credit side. So we credit note payable for 5,000, and then we post it to the equipment account and to the note payable account. The next example, the firm received 1,200 cash advance from another firm for the advertising service that are expected to be completed. So in this example, the firm already received 1,200 cash, so the firm's cash account increased. However, the firm hasn't performed any service yet, so the firm cannot record it as revenue because the firm hasn't earned anything yet. However, the firm already received cash. So this actually creates a liability for the firm. The firm now has an obligation to provide that service in the future. And that obligation that is recorded, the name we call it is called unearned service revenue. And earned service revenue, it is not a revenue account, it is a liability account. It represents the firm's obligation to perform service in the future. So cash increase, the increase in cash is recorded in the debit side, and the unearned revenue, because it's a liability, so the increase in liability is recorded at the credit side. So we debit cash, credit unearned revenue, and cash is posted to cash account. Unearned revenue is posted to unearned revenue account. And as you still remember that previously we already debited cash 10,000. Here we just make another journal entry, we just make another posting, so that we increase cash again by 1,200. Example 4, the firm pays office rent for October in cash 900. By paying this office rent, the firm first incurs an expense, which is an office rent, and then the firm pays this office rent. So this causes a decrease in cash, which is credit cash 900. And because this is also an expense for the firm, so an increase in expense is recorded on the debit side, which is debit rent expense 900. So again, we post it to the cash account, but this time we post it to the credit side of the cash account. And we also post it to the rent expense account. Example 5, the firm pays 600 for a 1-year insurance policy that will expire next year in September 30th. So now the firm pays 600 for 1 year insurance policy. The firm pay out cash, so cash decrease. That's why we credit cash 600. And then this is for a 1 year insurance policy. And by purchasing this insurance policy, the firm actually has the right to enjoy whatever is offered by the policy in the next 1 year. So this is actually an asset for the firm. The benefit of this asset is going to benefit the firm for the next 1 year. So we put it as an asset account. And this asset account is called prepaid insurance. An increase in an asset is recorded on the debit side. So we debit prepaid insurance for 600. And cash, so in the posting stage, we post it to the cash account and prepaid insurance account. So one question with regard to this example, one question that you may ask is, how do I know if the firm pay out something for some kind of expense? How do I know when we should record it as an expense and when we can record it as an example here, that as an asset, as a prepaid insurance, which is an asset? And the general rule here is, if the payment is just to benefit the firm for 1 period, for the current period, that is the expense. And if the payment is to benefit for the firm for future periods, we need to put it as an asset and prorate it. It's going to go into the expense gradually in future period when the firm is enjoying that benefit. So for example, in this one, this 1 year insurance policy is going to benefit the firm for the next 1 year for 12 months. So we first put it as an asset on the firm's balance sheet. And then we're going to recognize it into expense in the next 12 months. So this is the general rule here. Example 6. The firm purchased an estimated 3 months supply of advertising material on account for 2,500. So in this example, the firm purchased those advertising material, and those are tangible goods for the firm. Those are called supplies. So supplies increase, and then the firm spend money purchasing those. Actually, it is purchased on account, meaning that the firm didn't pay cash immediately, but instead the firm made a promise to pay those cash in the future. So this generates an obligation for the firm. So we debit supplies because supply increase, and then we credit account payable, which is an obligation, which is a liability, and the increase in account payable is recorded on the credit side. And then we post it to supplies account and account payable account. Example 7. So in this example, the firm hired 4 employees to begin work on October 15th. Each employee is to receive a weekly salary of 500 for 5-day work week, payable every 2 weeks. So in this example, this transaction, the firm just hired some employees, but if you look, has the firm's asset changed? No, it hasn't changed. Has the firm's liability changed? No, it hasn't changed, because those employees hasn't begun working yet, and the firm doesn't own them anything. Has the firm's stockholders' equity changed? No, it hasn't changed. Again, those employees hasn't worked yet. So it's not an expense. The firm hasn't generated any expense. So this transaction, it doesn't affect asset, it doesn't affect liability, and it doesn't affect stockholders' equity. And that's why for this transaction, we don't need to record it. Example 8. So the firm's board of directors declare and pays 500 cash dividend to stockholders. This transaction is going to cause a decrease in cash. So we credit cash, and it's going to cause an increase in dividend because dividend is going to be on the opposite side of the asset account. An increase in dividend is going to decrease stockholders' equity account, and the decrease in stockholders' equity is recorded as debit. So we debit dividend 500, and this is going to be posted into the cash account and into dividend account. Number 9, the firm owes employee salaries of 4,000 and pay them in cash. So the firm pays out those 4,000 in cash decrease. And in order to record that decrease in cash, we credit cash. At the same time, this is an expense for the firm. So salary and wage expense increase by 4,000. And we post it to the cash account and to salary and wages expense account. Example 10, the firm received 10,000 in cash from another firm for advertising service performed in October. So the firm received cash, so we debit cash because cash increase. And this is for an advertising service the firm performed. So this is a revenue for the firm. Specifically, it's a service revenue, and the increase in revenue is recorded on the credit side. So we credit service revenue for 10,000. So cash increase and service revenue increase. So those are examples of posting. And here is a summary of all of the journal entries we just made. And here is the general ledger, which contain each individual account. So all of those are accounts that was affected just now by those journal entries. And this is an overview of the effect of those journal entries on each individual accounts. And then after we have done posting, the next step is to make a trial balance. What is a trial balance? Trial balance basically, it is the list of accounts and their balance at a given time. So here's an example of a trial balance. For example, for the cash account, after made all of those journal entries and done all of those postings, we're going to have a balance for the cash account. And the balance is going to be on the debit side of 15,200. So on the trial balance, we take cash 15,200. And for supplies account, the balance is debit side 2,500. So supplies 2,500. Basically, we just take all of the accounts and their balance and we make them into a list. And then because every time we make a journal entry, debit should always be equal to the credit side. So after we have made the trial balance, the total amount which summarized the total debited amount we have made in all of those journal entries should always be equal to the total amount on the credit side. So this is a trial balance. So this class, we basically talked about step 2, 3, and 4 of the 9-step accounting cycle, how to make a journal entry, how to do posting, and what is a trial balance. And in next 2 classes, we're going to continue to talk about the rest of the steps in the 9-step accounting cycle.